I like net lease because I think that it's very stable, it's very secure. When you look at the large institutions, the large real estate investment trusts and funds and family offices, they're all investing in net lease. It's a very stable and secure asset. It's very predictable, right? With your multifamily, you don't know what's going to happen. You don't know what your vacancy is going to look like. You don't know what kind of repairs you may or may not need. You don't know what market rents are going to do. In my triple net lease deal, I know exactly how much rent I'm collecting. It doesn't matter how much taxes or insurance or repairs are.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Well, today, and actually over the next few days, we're welcoming back a guest. His name is Dan Lewkowicz, and he is a senior director at Encore Real Estate Investment Services, specialized in shopping centers, medical office buildings, pharmacies, quick service restaurants, automotive repair, parts stores, as well as some resorts as well. 15 years experience in real estate. He started his career actually house hacking, moved on to flipping houses, or a house in Detroit, and then founded Renaissance Real Estate Ventures. But he's done a few different things, but now he's a broker in triple net or in net investing, and he is just making it happen. And he's going to lay out a number of things that you need to know. I don't care whether you're active or passive. You're going to learn a lot from Dan today. He's going to dive in right away. We're going to talk about the economy and bring out just what he believes is going to happen. Right? What is the economic outlook? What he thinks about it, what he's listening to, and some of the things that are affecting that. He's going to go in even to a company that filed bankruptcy and why, and we're going to try to learn from that as well. You're going to hear us in other segments go into some examples that he's going to dive into around triple net, and some value add ways that, hey, maybe something you've never thought about, but whether you're active or passive, again, you're going to learn from him. In third segment, we actually took a turn that I didn't expect, and I love those episodes as well, where we can pull out something from someone that's important to them, that's helped them perform at a high level, that you don't typically get to talk about on the show. And Dan does just that and adds a ton of value. Dan, welcome back to the show. Honored to have you on again. And I want the listeners to know right up front, we're going to do a series here and talk about a number of different things and bring out some of Dan's expertise that we all need to know at the moment, all the times, but especially at the moment. He's got some things that I know are going to help you today. Dan, welcome back.
Hey, thank you so much for having me. I had a great time last time, and I'm looking forward to this time as well.
Yeah, me too. One thing Dan mentioned right off the bat was just, something that I feel like almost anybody in this space has to have. And he's talked about this steadfast determination, grit, it takes to get deals done, and, a team that's on top of every single little nuance. That's how you worded it. I love that. I love that determination to just, it's kind of like whack-a-mole, right? Any kind of nuance that pops up. Hey, how are we going to, be on top of that the next time, right? Who's in charge of that? So we know we're on top of this. And what he said actually, so investors can just sit back, and I love that as well. So, but Dan, let's jump right in. I know it's been 2 or 3 years since you were on last. But remind the audience who you are, what you do a little bit, the type of asset class that you all are focused on, and let's dive in.
Sure. So I'm Dan Lewkowicz. I'm a senior director here at Encore Real Estate Investment Services. We're kind of like a boutique net lease investment services firm. We sell commercial real estate all over the country. We've got 37 agents. Last year, we sold 320 properties in 43 states, totaling $985 million. So despite the fact that we're kind of a small to medium-sized shop, we are a huge shop when it comes to volume. We sell everything from pharmacies to discount retailers like dollar stores, auto parts repair and service stores, medical office building, industrial properties, shopping centers. I personally have sold some resorts. Everything that we sell is typically going to be high quality investment real estate. And we represent buyers and sellers all over the world. And we really love what we do. So my expertise really is in shopping centers, dollar stores, discount retailers, pharmacies, medical office buildings, and a lot of quick service restaurant. I didn't mention that. I do a lot of quick service restaurant sales. And yeah, we love what we do. We're very good at it, and we are excited to work with investors, of all sizes from all parts of the world.
Love that. And you mentioned a number of of descriptions of asset class that you all are focused on there. Give a high level of what triple net means, a little bit maybe
Sure.
for our newer passive investors or active investors that are listening, and then we'll dive into some specifics.
Absolutely. So when I get that question, I like to tell you what net lease is by telling you what net lease is not, by making the comparison to a well-known asset class called multifamily, right? So if you have a multifamily property, an apartment complex, and that apartment complex brings in, it's a small one, we'll call it, 10 units. Let's say that property, they're paying $12,500 a year. So those 10 units are yielding a gross income, right? And this is key, a gross income of $125,000 per year. Now, at the same time, you've got a Wendy's property, right? So it's just typical Wendy's that you see in every town and every state and every part of the country. And that property, Wendy's, either Wendy's corporate or the franchisee, if they're the one that has signed the lease, we can talk a little bit more about lease guarantors later. But in that regard, they're paying $125 as well. So apples to apples, right? You've got one property bringing in $125,000 annually, and another property bringing in $125,000 annually. Now you have to dial down a little bit and look at the expenses. So if you look at a multifamily property, you have things like property management, insurance, taxes. You might have some vacancy. You might have to do some capital expenditures, repairing the parking lot, repairing the roof. Not uncommon in multifamily for your expenses to be about 50% of your gross income. So that $125,000 annual gross collected rent or annual gross income could go all the way down to, let's call it, 60 grand. Now, flip back to the Wendy's deal, right? That's an absolute triple net deal. So what that means is that Wendy's, either the corporation or the tenant, whoever's on the lease, is responsible to pay not only the rent, but they're responsible to pay the taxes for your building, pay the insurance for your building, pay for all maintenance, any management, groundskeeping, et cetera, snow plowing, parking lot, roof structure, all that jazz. That's called an absolute triple net lease. And the reason it's called that is that $125,000 of rent is net to the investor. That is exactly what he or she collects. So that's the way that I describe, the difference between, triple net and other asset classes. Now, within triple net, when there are some nuances, what I described as an absolute triple net deal, right? There are other deals that in some part of the country, they call them triple net. Where I live, they call them double net. Those deals are very similar. Tenant pays for the taxes, the insurance, and the maintenance for the building. However, they don't pay for large capital expenditures like things like the roof and the structure, and sometimes even the parking lot. And then you can go down from there. You have, single net deals or gross modified deals. But in general, that's how a triple net lease structure works.
No, that's a great comparison. I like the thought process there, of one asset class to the other and some simple numbers there, just so we can all wrap our mind around what you focus on. And maybe just even another thought there on, why strictly focus on this type of property and not multifamily.
So now, when you say why, are you saying as an investor or as a broker?
Let's say broker first.
Oh, broker first. That's the harder one. I like net lease because I think that it's very stable. It's very secure. When you look at the large institutions, the large real estate investment trusts and funds and family offices, they're all investing in net lease. It's a very stable and secure asset. It's very predictable, right? With your multifamily, you don't know what's going to happen. You don't know what your vacancy is going to look like. You don't know what kind of repairs you may or may not need. You don't know what market rents are going to do. In my triple net lease deal, I know exactly how much rent I'm collecting. It doesn't matter how much taxes or insurance or repairs are. And furthermore, all net lease deals have if there are rental escalations or increases in rent, those are built into the lease from day one. So when I'm buying that deal, I know what my rent is going to look like. I can look at a spreadsheet and know what my rent is going to look like every month for the next 20 years. It's not something you can say with other commercial asset classes. Now, as it pertains to your question, with regards to investors, I think it's very similar, right? Net lease is very secure, it's very stable, it's very predictable. It's all the things that I would want in an asset, in an investment, if I'm putting my dollar somewhere. So I think that I like it for the same reasons. I think that stepping aside from a broker perspective, transactionally, I like the fact that I can look at a Wendy's anywhere in the country and in 3 minutes have a really good idea of that property as it pertains to the lease, the guarantor, the demographics, the traffic counts, the population density, average household incomes, et cetera, et cetera. For me, at least, there are so many different multifamily buildings all over the country that are very different from one another. So I kind of like that cookie cutter aspect of it. I like the fact that I can dial down and very quickly tell you what your property is worth because of the fact that I'm an expert in a very specific niche of commercial real estate.
Yeah, no, I like that. I like team members like yourself who are very focused in a niche, right? Or focused in an area. So they are an expert, right, in that specific thing. And that's who you want on your team. Right. And so I love that. So let's dive in a little bit to I wanted to just get right to it because I know the listeners want to know this. They know I'm going to ask typically later in the show, but because of your experience and really expertise in this niche and across the country, right? I feel like you said 40 some states, 320 properties last year. Just really the economic outlook, right? What's Dan expecting to happen in the next 6, 12, 18 months? I say, I know nobody has the crystal ball, right? But what we believe is going to happen affects what we're doing today, right? And so I just wanted to jump right in, and let's just say, okay, well, what's Dan believes going to happen? What's your thoughts, as even as you're talking to lots of investors, right? And they're having thoughts and concerns, or maybe they're gung ho right now, or maybe many are reserved. Just kind of how you're feeling out what's happening right now.
Sure. Yeah. This is something I talk about a lot. Right. I'm either going to get, a lot of people yelling at me in 12 months or people forgetting that I said what actually is going to happen. But we'll see. We'll see the way that it pans out. And I'm just kidding. It could pan out in a positive direction too. So it's a very tough question to answer. I mean, I think for anyone, especially like right now, I think that in the past, it's been easier to answer that question. What I will tell you is that we've seen the federal funds rate go up 525, 550 basis points. So 5.25 or 5.5% over the last 15 or 16 or so months, right? If I look at each of the sectors that I've described in net lease and told you how much the cap rates have risen, you'd be floored because in most cases, we're looking at changes between 25 and 75 basis points, right? That's probably roughly about 10% of the change. And as we know, right, there are cash buyers in any market, but a lot of buyers are finance buyers. And really, when you look at a deal, you look at the cash on cash return. And if you're going to look at the levered cash on cash return, you have to have some type of a positive spread, right? So 15, 16 months ago, when you were buying a building, right, at a 5 cap, right, a 5% return, but you were getting your financing at 3%, okay, that makes sense. But what about today when your financing is at 6.5 or 6.75% and your cap rate's at 5%? So to me, I'm amazed because, and I think this just goes to show you, it's a testament to the strength of net lease. Net lease has stood firm. I think dollar stores are the segment in my market that have seen the most swing, arguably. And that's likely because over the last 10 years, they went from 10 caps to 9 caps to 8 caps to 7 to 6 to 5, right? So they went down very quickly. And typically, the faster they in this case fall, but the faster the cap rate goes down, faster it's going to go up when something changes. But even dollar stores, 75, 100 basis point swing, maybe 125 basis point swing, that's still nowhere near 525 or 550 basis points. So that just goes to show you the strength of net lease and the stability of these assets. In terms of what's going to happen, I follow the Federal Reserve very closely, as I'm sure you do. And I listen carefully, not only to the announcements, but to the nuances and to the things that people like, Jerome Powell, tend to speak about. And it seems to me like, we're in for maybe one more increase in rates this year, but it seems like the rates are going to taper off. I think that, we could get into the conversation of CPI and what it is and whether it's an accurate measure or whether it just gets changed every time the BLS wants to change it. You might be able to insinuate what my opinion is, but regardless, that's a metric that Jerome Powell and the Federal Reserve Board look at closely. And in their eyes, they've done a great job of getting that down from something that was, potentially runaway inflation to something that's much more manageable. So that being said, I think they're going to take their feet off the gas a little bit in terms of interest rate hikes, which I think, this economy. I mean, if you read the news, you would think that the Dow was crashing and the Nasdaq was crashing and commercial real estate's in the toilet. But go pull up the stock market today. I mean, you're looking at historic highs across, in major indices, which is incredible. Look at real estate. Values have been relatively unaffected. It's incredible. And if you look across at things like residential real estate, I mean, which, it's not my expertise, although I do have a lot of experience investing in residential real estate, but, not as a broker. You look at things like prices, right? Now, what's gone on in these changes with the interest rates, for example, it's really forced people to hold their property and made the market even tighter. There's an undersupply across the country in residential real estate, and that's why prices really haven't budged very much, which to me is incredible. So I think that once we're able to have a period of, in my opinion, 9 to 12 months of interest rate stability, no major hikes or decreases in interest rates for 9 to 12 months, that's when we'll see really where the market is. But I think this market is still strong. I think this market is still hot and still poised to grow once things, stable out, which is not what we've been hearing, right? And what's very interesting, my biggest takeaway from the meeting last week was that Jerome Powell mentioned the consensus amongst everyone in the group is that we are no longer headed for a recession, which is a complete reversal, and it's something that I'm elated to hear. So I really have a very positive outlook. Now, I will tell you what I'm seeing as a broker, and I think I see things more on ground zero than most people, even than investors, is that there's a lot of opportunities in distressed assets, right? Because there's a lot of corporations that had a very difficult time handling the roller coaster of the pandemic and the post-pandemic and everything that's gone on, labor shortages and supply, increase in costs of goods and labor, which has been very, very, straining. So what that's doing is that's causing certain operators of real estate to file for bankruptcy. Now, what's fascinating, Whitney, is that the actual underlying real estate is very valuable. Not that the real estate had a problem, it's that the company that was operating the real estate had a problem. I'll give you a perfect example. I've got a Burger King that I listed for sale, operated by one of the larger franchisees of Burger King called Tom's Kings. Tom's Kings has 91 locations, had 91 locations. Well, come March of this past March of this year, they filed for bankruptcy and they got out of all of their sites. So that underlying real estate was great. That's not the problem. The problem is the operator couldn't handle whatever business difficulties they were having. So I see this all across the country. So what that does is that presents an opportunity for a new investor to come in, buy this vacant building, right? Deploy some tenant improvement dollars, some capital expenditures, put a new tenant in there, sign a new lease, and maybe make $500,000 or $1 million in equity on the deal. So I'm seeing more and more of that, and because of all of this, tumultuous, factors that have been going on, I think that that's a great opportunity for investors today, especially in the area specifically of net lease.
Wow, a corporation or a company that had 190 stores.
They had 91 locations. So
91.
Pretty big.
Yeah, still 91 locations filing for bankruptcy. Man, I know maybe this is, not privy to you. I don't know. I just wonder what was their problem? What happened for them to have to go bankrupt with that size of an organization? Because all of us want to learn from that, right? And sure, we're not making the same mistake.
From what I've heard, and by the way, a month later, Meridian filed for bankruptcy. They had 119 locations. So my understanding is that both of those companies suffered from over expansion. They built too many new stores, and they renovated too many new stores, and they spread themselves too thin. And then all of a sudden, what happened? Boom, they got shut down. Boom, labor prices went up. Prices of foods rose faster than they've risen in 40 plus years, right? Wow. And they had labor shortages. So I'm talking to clients of mine all across the country who own and operate these properties, because many times I don't just deal with the investors, I deal with the actual operator. And they're closing their stores for many hours during the day. They're just not able to staff them. So what is that going to do to your sales and your bottom line, right? It's a very difficult situation. But again, that's opportunity for the next guy.
Wow. Yeah, that is an opportunity. How do you see some of your clients now being prepared for opportunities like that? Like, I don't know, just thinking about the operators that are listening right now, that would be a prime, client of yours, right? How can they be prepared to take advantage of opportunities like that?
Well, first of all, if you own real estate, you need a property evaluation, what we call a proposal or a broker opinion of value. And there's no reason not to get one. I mean, you reach out to someone like me, I'll have you one within a few days, no cost. It's just a valuable piece of information that'll tell you exactly what your property is worth. Because chances are it's not worth what it was worth a year ago, even 6 months ago. Definitely have been major changes. So on the ownership side, that's definitely what I would recommend. If you're an investor and you want to, get kind of take the next step, I would just say, continue to look at deals, continue to underwrite deals. If you need an extra pair of eyes on a deal, reach out to me. I'm happy to give you my opinion. But keep your eyes open, because there's going to be a lot of opportunities. And what I see happening, this is going to happen big time in multifamily, but it's going to happen in net lease as well. Over the next 24 to 48 months, there's a tremendous amount of debt that's coming due. So, right, remember I talked a few minutes ago about the 5 cap deal that at 3% interest rate made sense, right? Well, that deal doesn't make sense at 6.5% or 7% interest. So as many people know, commercial mortgages are not like your residential mortgage where you lock in for 15 or 30 years. Your typical commercial real estate mortgage, it might have an amortization of 25 or 30 years, but it typically has a balloon in 5, 7, 10 years. So many of them are 5 or 7 years. So all these people that locked in at these historically low rates, right? The deal made sense. The 5 cap deal at a 3% interest rate made sense. But once that debt comes due, they're in big trouble because the deal's not going to pencil. They're going to have negative cash flow. And even more importantly, to meet the lender's standards, right, of loan to value and debt service coverage ratio, they might have to actually bring capital to closing. It would be like a cash in refi. That's going to cause a lot of sellers that are going to be selling, and that's going to create a lot of opportunity.
No doubt about it. One more quick thing before we end this segment, Dan. Just speak to the relationship of, say your top clients and somebody like yourself right now. Like, how are they top of funnel for you to see the next deal or opportunities like this?
Yeah. So, that's just the way that it works in our world. I've got my guy for shopping centers, right?
Yeah.
He's bought shopping centers from me before. He performs. He does a great job. If I have a new client or an existing client that's selling a shopping center, the last thing I want to do is bring them a buyer that's going to, be a problem buyer or try to retrade tremendously or walk out of a deal or something like that. So if I've got someone like this individual in my pocket who I'm in touch with every single day of the week, believe it or not, showing them deals, right? That's going to be the first person that sees the deal. And I tell my clients that I'm listing the shopping center for, I say, listen, I want to put all the cards on the table for you. We can list this property, right? We can put it on the market. We can see who's going to come to us, and we may find somebody I worked with before, or we may find a new buyer. But chances are there's going to not going to be somebody who's tried and true, who has a track record of closing deals with me in the very, many deals in the recent, past. So some sellers will say, put it on the market. And I know what, we put it on the market and maybe we sell it, or maybe the original buyer comes back at a lower price. But a lot of sellers are going to say, Dan, you got a relationship with this guy. Let's see what we can do with him. So it's so important to have relationships with brokers. This guy gets a first look at almost all deals. If I think it fits him, whether it's my deal or somebody else's deal, I put it in front of him, right? And the same thing goes for other asset types, right? So, over the years, I've developed my core buying clients. They're seeing these deals first, and it's not just like giving them an unfair advantage. They're seeing it first because they're a higher caliber buyer, period. And as a broker, my job is to match the highest caliber buyer who's going to give the best price with the best terms and make everybody's life as easy as possible. And in many cases, the easiest way to do that, the most likely way to do that is as I've just described.
They've performed, right?
Yes.
They performed with the least amount of hassle, and it's been very steady. Right? They've done it.
As a broker, the worst feeling is going back to a seller and saying, hey, I'm sorry, but so-and-so didn't perform. We have to take it back out to market. I hate that. Those are the calls that keep me up at night. I like to avoid those the same way I like to avoid things like the plague.
No doubt about it. Dan, grateful for your time in this segment. We're going to end this segment here, but I still want you to tell the listeners how they can get in touch with you and learn more about you.
Sure. Yeah. Well, first of all, thank you so much. This has been fun, just like it was last time. I really appreciate it. So yeah, please reach out to me if there's anything I can do. I'm very active on LinkedIn, so you can find me there. Dan is my first name. Last name is Lewkowicz, Lewkowicz. Again, Lewkowicz. You can Google my name too. I'll come up on tons of podcasts like this great one here. And then also, happy to just give out my direct cell phone so anyone can reach out to me directly if there's anything that I can do. That number is 248-943-2838. Again, 248-943-2838. If you have commercial property, you have to know what it's worth. If you have commercial property that you want to sell, you have to call me, because I can guarantee you we're going to hustle harder. We're going to work harder. We're going to, make sure that you can sit back and relax while myself and my team handles every single aspect of the transaction.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.